Go to Breakeven, chapter 31. When we talk about breakeven, it means your total revenue, your total cost of production equals your total revenue. That's breakeven. Total cost equals to what? Total revenue. So yeah, this is a situation whereby a business generates just enough revenue to cover its total costs, which is the same as they could ask in the exams what is total breakeven. Just like total revenue cost equals to total revenue. That means the business is able to generate enough revenue to cover up the total cost. Is it clear?
Yes.
Then we have contribution. When you talk about contribution is your selling price minus your variable cost. Contribution is selling price minus variable cost. So what is contribution itself? This is the amount of money left over after variable cost has been subtracted from your revenue. So your contribution, you use contribution when you need to solve your break-even. Do you understand? So contribution itself is your selling price minus your variable cost. You know variable cost that changes as output changes. Are you with me?
Yes.
So we have contribution per unit and total contribution. So for contribution per unit, I told you earlier, it's selling price minus variable cost. Then your total contribution is your total revenue minus your total variable cost. Don't get it twisted. Your contribution per unit is your selling price minus your variable cost. Then your total contribution is your total revenue minus your total variable cost. Is it clear? We have break-even point. Break-even point is the point at which your total revenue equals your total cost. We have break-even output. Break-even output is the level of output that can be produced to meet up the total cost. That means the level of output that will equal to the total revenue. That will make our total revenue equal to our total cost. Do you get it? That's break-even output. The level of output that you need to produce to reach your total cost. So the level of output the business needs to produce so that the total costs are exactly the same as the total revenue. That's your break-even point output. Is it clear?
Yeah.
So the formula for break-even output is fixed cost divided by contribution. I know what contribution is. Your selling price minus your variable cost. So that means your break-even point or your break-even output is fixed cost divided by selling price minus variable cost. Do you understand what I just said? So your break-even output is equals to fixed cost divided by selling price minus variable cost. FC divided by SP minus VC. Are you with me, please?
Yes.
Now go to break-even chart. A break-even chart is a graph showing the break-even, showing the total cost and your total revenue. The graph representing your total cost, your total revenue, and the level of output. So here I wrote, it is a graph containing the total cost and total revenue lines. So the vertical line represents the output, and the horizontal line represents the revenue and whatever you need to put there.
Yes.
So here, what does the break-even chart shows? The value of total cost over range unit of output. So the value of your total cost with the output, because the output shows in your break-even chart. The value of your total revenue with the range of output. So you get to know your total cost. Your total cost is above. Then your total revenue is above the total cost. That means your fixed cost, you have your fixed cost, your variable cost, your total cost, then your total revenue. So your total revenue must be above the total cost. Are you with me, please?
Yes.
So your chart will show your total cost with the range of output, your total revenue with the range of output, your fixed cost with the range of output. The lines below the break-even, which will be your loss. The line above the break-even is the profit. The distance between the profit and loss is the margin. Do you understand? The margin of safety. Is it clear?
Yes. So
the line in between the profit and loss is what we call margin of safety. You have any question for now?
No.
So margin of safety. The range of output between the break-even level and the current level of output over which profit is made, which I just explained now. we go to break-even analysis. What is break-even analysis? It is used as a tool for business decision. So what do we use break-even analysis for? One, it helps the business to know what to be done when prices go up. Mm-hmm. So whenever prices go up, with your break-even analysis, you'll be able to know what to do. Either to reduce output or to increase output, or whatever you need to do, you'll be able to know with your break-even analysis. Two, how to go about introducing new product lines. So when you are introducing new products, so what you need to do, you would know through the break-even analysis. Three, what has to be done to prevent losses, especially for new businesses? Like we said, your break-even chart will show you the margin of safety. Mm-hmm. So as a business, you'll be able to know what to do, not to make loss. And lastly, it is found in a business plan. You can use it, it's part of your business plan, your break-even analysis. Because you have to explain to the bank manager, you have to analyze with the bank manager how you are preparing, you're making plans to make profit. Yeah. And if you are not making profit, how do you want to reach break-even? What are the problems of break-even analysis? Problems are the same as limitations. Number one, output and stocks. It assumes that all output is sold, but sometimes businesses may hold stock due to low sales. So when you are using break-even analysis, it is considered that you are going to sell all your output. But most of the time, businesses do not sell all their output. So that means your break-even analysis is wrong. Two, on changing conditions, there are some factors that you cannot change. That it's not easy for a firm to quickly, be flexible with, like increase in wages. It's difficult for firms to quickly change them, to meet up with their break-even. Price increase. When price increases, it's not something that you can just quickly work on. And lastly, change wages, increase in wages, and technology. The fourth one, accuracy of data. The effectiveness of a chart, listen please. Mm-hmm. The effectiveness of a chart depends on the amount of money you can spend in gathering information. So if the data has poor quantity or poor quality, or there's no expenses, there's no finance to put up this data, then your analysis will be wrong or incorrect. Last one, non-linear relationships. It is assumed that the total revenue and total cost lines are the same. But most of the time, firms do give discounts. To increase sales, they give discounts. Because they give discount, that means their total revenue will not be the same as the total cost. Mm-hmm. Multi-product businesses. When you're talking about using break-even charts, there's assumption that the variable cost is constant. But here, a business could have different variable costs because it produces different products. Do you get what I'm saying here? Yeah. So it's difficult for a business that produces different products to use the same break-even chart. Stepped fixed cost. So in here, fixed cost might not be fixed. It might not be stable. Why? Most of the time, when you are as a business, you already know that you need a break-even output. And to meet up with your break-even output, you might need to produce extra output. Yeah. Producing extra output might mean that you need to increase your capacity. That means if you have to increase the capacity of your factory or of your premises, your fixed cost will not be constant anymore. That's the problem about break-even